Hello, welcome to this video where we are talking about options. So we'll be going through two things. Firstly, when should you use options? And secondly, what are options? So options are a type of financial derivative. So how is options different? So in traditional stocks, what you do is that you hold the stock and you wait for the price to appreciate. So for example, you buy one stock of Apple share at $100 and then you sell it at 200, and the capital gain you earn is 200 minus 100, which is $100. So the only earning that you can get is through that increase in share price, which is called the capital gain. And if your Apple share doesn't increase in value, let's say it stays at $100, you don't sell it, of course, because you won't earn anything, and you don't earn any income while waiting for it to increase. So how this is different in options is that in options you can buy the share and you can also sell an option to earn 2 to 3% of what stocks you hold. So what I mean by this is that, for example, you buy your Apple share at $100, and while waiting for it to appreciate, you can sell premiums and earn a monthly income. So without selling the actual stock, you can earn premium or monthly income here. So if the stock doesn't increase in price, so Apple stays constant at 100, you can still earn monthly income, roughly 2 to 3% per month. So besides capital gain, you can earn premiums. I'll talk more on this later. So the second way in which how options are different is through buying. So in traditional stock investing, you have to buy the stock at the current price or wait till the price drops to your desired price range. So it's either buy now or wait. So like my example earlier, let's say Apple share is trading at $100, but you don't want to buy it at $100, you want to buy it at $90. So you have to wait for it to drop, then only you can buy it. So for options, how this differs is that you can either buy the stock at your desired price or get paid to wait. So remember, by buying an option, you get paid to wait for your option to reach your desired price. So let's go back to the example. The current price of Apple is $100 and you want to buy it at $90. So without using options, all you can do is wait till it drops to $90. It might or might not drop, and you might or might not buy it. For options, you can sell a put option. So if it drops to $90, you would buy it at a discounted price. So that's good for you because you hit your target price, $90, you buy it. If it doesn't hit your $90, you earn a premium. Again, you get paid to wait. So it's a win-win situation in both cases. So the third case in which options are different from traditional stocks is when selling the stock. So let's say you think, oh, the stock market is not doing well. My Apple share that I hold is going to drop. So if you think the stock price will fall, you would want to sell the particular stock. And let's say if you're wrong, Apple doesn't go down, it goes up instead. You lose out on that potential gain. So that is what you would do with traditional stock. You have to sell it, and if it goes up, you lose out on the potential gain. For options, this is again slightly different. Options give you the ability to profit when the stock falls, but not sell your stock if, let's say, you're wrong and the stock price still goes up. So this is hedging. So you can sort of lock in your profit by paying a small sum. So this time you pay a premium, you lock in your profit. If the stock goes down, great. You can sell you can have that profit as if you sold your stock at that price you set. And if you're wrong, let's say the stock goes up in price, all you lose is that small sum of premium that you paid, and you don't lose your shares. You can't do this with traditional stocks. And lastly, the fourth difference between the traditional stock buying and options is leverage. So in traditional stock investing, you can only buy using the money you have in your account. So you are sort of limited by the cash you have in your account. So for example, let's say you have $1,000 in your investing account. You can't buy more than $1,000 worth of shares because that's all you have. In options, you can use $1,000 in your account to purchase $10,000, let's say $10,000 worth of stock options. So let's say the stock price increases, you profit a lot more because now holding $10,000 worth of stocks, and this is leverage. So in summary, I give you 4 reasons on why use options. So you can use options to earn monthly income even though the stock price is an increase. You can use options to buy stock at a huge discount or get paid to wait. Third, you can use options as a way to hedge in case of a market downturn without selling the shares that you own. And lastly, speculation play. You can leverage and control more shares than the money you have in your account using options. So now we move on into what are options. So before we looked at why use options, now we look at what are options. So there are two types of options. Firstly, there is a call option and a put option. I will go through both of them in detail. So number one, what's a call option? So a call option is basically a contract that gives the buyer the right to buy 100 shares of a stock at a specific strike price on or before an expiration date. So you have the right, if you buy a call option, you have the right to buy 100 shares of a stock at this price that you agreed on or before an expiration date. And typically it's displayed like that. You see in such format, the first part is a ticker symbol. So this is the option for the underlying stock, and in this case AAPL, which stands for Apple. Second, you have the date the option expires. So remember, there's expiration date, December 18th. Here is expiration date, and most of the time expiration dates are Fridays. So every week that it would be Friday. So the next one could be like December 25, but that's a public holiday. Uh, next, third third thing here is the strike price. So the strike price is 150. Next, the type of option. So this could either be a call option or a put option. And lastly, the premium. So the premium the small sum, which I mentioned earlier, the premium that you have to pay to buy a particular option. So remember, if you let's say you buy a call option, you would have to pay this premium. And once you pay this premium, that gives you the right to buy 100 shares of stock at a specific strike price on or before the expiration date. So you sort of have that option to buy 100 shares of Apple at December 18 or before. So now I'm going into more detail for call options. So for a call options, there are two parts. So the first on the left hand side here is the call buyer. And if there is a buyer, there must be a seller as well. So you know how you go to shops. If you buy something, there has to be someone that sells it to you. So if you remember of a definition of a call option earlier, it is a contract for the buyer to have the right to buy 100 shares of a stock. So at a particular strike price on or before an expiration date. And a buyer has to pay premium to get the right to buy. So here the buyer pays premium, the seller gets the premium, and let's say if the call buyer wants to exercise his option, the call seller then has to deliver 100 shares at the particular strike price. So now you can see how this works. An option buyer will pay the option seller a premium. So let's go to an example here. Let's say there's an option contract. The call buyer buys an option contract for the right to buy a stock price at $150. So in this case, the call buyer will pay a premium to the call seller and has the right to buy the call seller at $150. So as a call buyer, you would want the stock to go up because let's say the stock price goes up to 200. Let's say the stock price go up to 200, you only have to pay $150 because you have the right to buy it at that price, and so you profit that $50 difference. On the other hand, for a call seller, you do not want the price to go up because if it is below 150, the call buyer would not exercise his option because if he exercises it, he'll be at a loss. And at 150, it's still good for you because at 150, you can still receive a premium plus selling the stock at the value. So note, as a call buyer, you are bullish, you want the stock to go up. As a call seller, you are bearish. You think the stock will either stay constant or drop. That means the call option will not get exercised and you get to keep your premium. So moving on to the other side, so we see call options. Now we go to put options. So a put option is a contract that gives the buyer the right to sell 100 shares at the strike price on or before the expiration date. So again, the first part here is the ticker symbol. Second part is the expiry date. Again, typically it's a Friday. Third part is the strike price, so the price that the buyer and seller agree on. Fourth is either a call or put. In this case, the put, and fifth is the price, the premium price. So again, we dive deeper. So very similarly to the buyer of the call option, the buyer here also has to pay a premium to the seller. So remember, this time put option, it's the right to sell. So the put buyer has to make a decision on whether he or she wants to sell the 100 shares at the specific strike price. So remember, buy is the right to buy. This time put is the right to sell 100 shares. So as a put buyer, you would want the stock price to go down. Why? Because if you have the right to sell it at a higher price, because you have the right to sell it at a higher price. So for example, the strike price for the contract is 150 and the stock drops to $100. So that's the market price, $100. You can still have the right to sell it at 150 because of your option contract. And thus you make a profit. And for the option seller, you want the price to go up or stay the same so that you can just collect the premium without being obligated to actually buy the 100 shares from the put buyer. So earlier, we mentioned about how options can be used as leverage. And this is where I will show you how you can use options as leverage. So calls can control large amount of stocks, a small amount using a small amount of money. So for example, Apple stock is, let's say, is trading at $150 now, and you expect it to increase to $200 in the future before your option expire. So remember, each option contract is 100 shares. So this is what you would do on this left hand side in traditional stocks. So what you do is that you buy 100 shares at $150, and that's a total of $15,000 that you have to spend. So it's basically one Apple stock costs 150, 150 times 100 equals to 15,000. And if the market value increases to 200, the total value of your 100 shares is now worth 20,000. And the profit that you make is 20k minus 15k, which gives you 5k. And you calculate your return based on your capital you put in. So you put in 15,000, you get a 33.3% ROI. So that's the scenario of a traditional stock buying method. Now let's move on to options and see how you can control much larger shares with much smaller amount of capital using options. So this time, remember, if you buy a call, all you have to do is pay a premium. And the premium here is $5. So $5 per share, 5 times 100. So the option contract is $500. And let's say the price increases to $200. So Apple share increases 150 to 200. And your option value also increases similarly. So now your option value is 50. So 200 minus 150, which is 50 times 100, which is $5,000. So that's the increase in value of your options. Because remember, an option is the right to buy 100 shares at a specified price. So the profit is 5,000, which is here, minus 500. Why I'm minusing 500 here is because I have to deduct the premium that I pay. So premium, you will lose it no matter what, because that premium is basically the price of the contract. But the important bit is that if you calculate your return after deducting the premium, you get 4,500 divided by 500 where you put in, and that's a 900% return. So you can see, using options, your return is much higher. This is leverage because using a small amount of capital, 500, you control a much larger amount of shares. So let's use some charts to explain all the previous concepts in more detail. This chart here is a risk return profile of buying 100 shares of Apple using the traditional method. So let's say you bought 100 shares at 150 here. So remember the previous example, 100 shares 150, you spend 15,000 here. If it goes up to 200, you earn 5,000. So remember the previous example, you saw that it goes up by $50, 200, you earn 5,000. If it goes down by $50, you lose 5,000. So it's like a linear profile. So this is the traditional stock buying method. It's a very linear. You go up, you gain proportionally. You go down, you decrease proportionally. So now let's take a look at the perspective of a call buyer. So let's say you buy a call of Apple. So this is buying a call. You buy a call of Apple at $150. And remember, you are paying a premium of $5 for this share. So this is where you are in the graph. You buy an option contract. You start off with a loss, mainly because at 150 is because you're paying a premium. So premium is 5 times 100, which is 500, which is the premium paid. So you start with a loss. So if the share price goes down below 150, like here, like it goes down, share price goes down to its left, your loss is capped at 500, you won't lose more. Look how this is different from traditional stock buying. If it goes, the more it goes down, the more you lose. But in option, it's capped. So there is limited risk. And let's say if it goes up slightly from 150 to 152, let's say it's here, you are still making a loss, mainly because your premium paid is more than the amount you're making through your options. So that's still a loss. And to what is this break-even point? So this break-even point is basically the strike price plus the premium. So remember, you paid $5 per share. So 150 plus 5, 155. This is your break-even point. So after going past this point is where you start making a profit. So let's say at expiration, your stock price goes up to $200. Your your profit is basically your stock price minus your strike price minus your premium, which gives you $45 times 100, which is 4,500 profit. So here you can see how by buying a call option, you have limited loss. No matter how much the stock price go down, you have unlimited gain if it keeps going up and up and up. So on the flip side, we have the call seller. So previously you look at the perspective of the call buyer. Now we look at the perspective of a call seller. So the chart here is just flipped on the x-axis. So it's just flipped on this x-axis. So same contract as a call seller, you have an obligation to sell 100 shares at $150 at the expiration date because the call buyer has the right to buy. So call seller, you have the obligation to sell if let's say the call buyer exercises contract. So the stock price goes down. So stock price goes down, you get to keep your premium of $500. So it's happy because you get to keep it. If the stock price goes up, you start making a loss. And let's say if the stock price goes to 200 here, you make a loss of 4,500. So it's a completely opposite from the call buyer. It's just flipped on the x-axis. So how do you calculate this loss? It's basically the strike price minus the stock price plus the premium. So it's 150 minus 200 plus 5, which is minus 45 times 100, which gives you 4,500. So to summarize, as a call buyer, you are bullish. You want the stock price to go up. You have limited loss and you have unlimited gain. As a call seller, you are bearish. So you want the stock price to stay the same. So stay the same 150, you still earn. Or go down, you have limited gain, which is this green part, limited and unlimited loss. So now remember, so earlier we look at call buying and call selling. Now we look at puts. So if you recall earlier, buy and sell for call means it's flipped on the x-axis. So a buy, a call buy, and a call sell is basically flipped on the x-axis. The difference between call and put this time is that it's flipped on the y-axis. So it's flipped on this axis. So put a, a put buying is basically the flip of a call buying. It's flipped on the y-axis. You remember the definition of put? It's a contract where you have the right to sell 100 shares at a strike price. So you have the right to sell 100 shares at the strike price on or before the expiration date. So in this example, we are buying a put at a strike price of 150 here. and the premium is $7.5. So the total premium you have to pay is 780 because again, 7.8 times 100, which is 780. So for buying puts, you get limited upside profit, limited upside risk and unlimited downside profit. So let's say if your share drops from 150 to 130, your profit again would be strike price minus stock price minus premium you paid times 100 shares, and that will give you 1,220. You can also calculate the break-even price, which is the price it has to decrease for you to recover your premium, and break even, which is the strike price minus the premium. So again, the hypothetical scenario, if the stock price increase to let's say 160, you lose your premium paid and you won't lose your share, because it wouldn't make sense for you to sell your 100 shares at 150 when the current market value is 160, because clearly you want it to sell at a higher price. However, when it goes down to let's say 130, you would want to sell at 150 because you have the option contract and you have the right to do so. So you can earn more money. So lastly, we move on to selling a put, which is again flipped on the x-axis on buying a put. So opposite of buying a put here, you have limited profit, but also unlimited risk with the same break-even price of 142.2. And how I calculate this break-even price is strike price minus premium. So if the share price stays the same at 150 or above, you get to keep your premium. If it drops below 142.2, you start incurring a loss. So this part here, you still make a tiny profit, although less than the premium you earn. So to summarize, as a put buyer, you are bearish. You want the stock price to go down. You have limited loss for unlimited gain on the downside. As a put seller, you are bullish. You want the price to go up, stay the same, or increase so that you can keep your premium without losing your shares, without having to buy the shares. You have limited gain and unlimited loss. So here is all together. You can see call. A call buy and sell is flipped on the x-axis. Between a call and put is flipped on the y-axis here. And you can see call, buying a call gives you the right to buy, buying a put gives you the right to sell, selling a call gives you the obligation to buy, and selling a put gives you the obligation to sell. So lastly, to summarize everything, call options. So when I buy a call, I have the right to buy 100 shares at a strike price. When I sell a call, I'm obligated to sell 100 shares at the strike price. For put options, when I buy a put, I have the right to sell 100 shares at the strike price. When I sell a put, I'm obligated to buy 100 shares at the strike price. So you can see the inversion here between buy, sell, buy. So if you find this video informative, do like and subscribe. Thank you.